So on a bad day for the markets and the economy, I caught up with fund manager Roger Montgomery and independent economist Stephen Koukoulas. Roger Montgomery in the studio and Stephen Koukoulas in Canberra. Great to have you both with me.
Good to be with you, Rachel.
Good to be here.
Stephen, we've seen the biggest weekly drop for both the Australian and US share market since the peak of the global financial crisis. Will this be worse than the GFC?
At this stage, probably not. The GFC was a banking crisis. It lasted a long time, and we saw a really deep and protracted global recession that took many years to get out of. It was a really severe problem. Now, at this stage, of course, we don't know how long the coronavirus will last, how long it will linger through the global system and through the global financial markets. But if they do find a cure, if they are containing it at some stage in the coming weeks and months, hopefully it'll be a blip and a nasty one, but it won't be an enduring thing like the GFC.
Roger, your thoughts? Is this a GFC moment?
No, I don't think so. Having said that, though, the panic can be much worse than the pandemic on markets, so that's important to remember. But unless we see economic activity start to change the appetite for debt refinancing, then I think we're going to be okay. It is temporary. This too will pass. And I think markets will bounce pretty strongly when it does. Having said that, though, it could be quite deep and in the interim.
Stephen, should investors be panicking?
Look, I don't think so, because again, there's a hope that when we do get a cure, a vaccination for the virus, that markets will then reassess the outlook for the economy. We are going to see policy stimulus, I think, thrown around the world. We've seen it already in China. The Fed's poised to cut rates. RBA's meeting next week. Maybe, just maybe, they're going to be trimming rates. And we're seeing policy easings around the world as central bankers and even governments respond to the crisis. So in a sense, there's a hint of confidence that, again, the policymakers are riding to the rescue, and if they do it reasonably efficiently, it should actually contain the fallout in terms of economic activity.
Roger, you're a fund manager. What have you been telling your clients today or indeed throughout this week?
Well, so we believe that the issue really is that the World Health Organization, the WHO, is still closer to declaring a pandemic than they are to declaring the danger having passed. In the interim, we've got the IOC talking about cancelling the Olympics. We've got the Japanese government closing down schools. We have Jamie Dimon coming out from JP Morgan and banning all international travel. So at the moment, there's a panic response. Now, whether that's valid or appropriate or not, it's not for me to guess. But that panic response can be more important for markets and market prices and confidence than the result of the pandemic and how long it actually lasts. So I think there's a very real risk that we see further weakness before we see any kind of recovery. And for that reason, we're explaining to our clients to be ready to invest more, to be ready to buy value when it presents, because there could be some very good value about. We're seeing share prices drop by up to 10-15% in a day for some stocks at the moment.
Stephen, we are on the edge of a looming pandemic. How big a hit will this be to growth? You mentioned, of course, the RBA meeting next week. What do you think they'll be doing?
Yeah, look, the odds must be increasing that they'll trim rates. The risk of them overinflating the economy are zero. So a rate cut surprising the market, perhaps pushing the currency even lower, to give our exporters a bit of a competitive boost, would be a wise thing to do. But as Roger's saying, we just don't know how severe this is going to be. We know it's going to be negative. We know the negative shock will be reasonably large. And in the case of Australia, it's actually coming off the back when the economy, while it was looking a little better at the end of 2019, we did have some slightly better news in different parts of the economy. The economy certainly wasn't strong. So this weakness that's unfolding is into a sluggish economy, and that's why we're getting a lot of people now really highlighting the risk that the March quarter GDP will be negative, and unless we get a solution to the coronavirus problem, that the June quarter could be shaky as well.
Roger, how will markets cope if COVID-19 does become a fact of daily life?
Well, that's interesting. I mean, the markets will go on and people will continue to invest. What's interesting is how sectors of the economy and individual businesses are impacted. So, for example, the effect on Qantas might be quite dramatic, or more dramatic now than we originally thought. The effect on Sydney Airport's very dramatic. Will the effect be as dramatic on consumption stocks or retail stocks? Well, that depends on the extent to which their supply chain is affected or adversely impacted. Companies like Lovisa, for example, that have a very high stock turn, they're going to be impacted if they can't source product from alternative countries to China. Companies are already shifting some of their supply chain management out of China and into other countries. That's probably going to be permanent. They won't reverse that very quickly. So there's going to be dramatic changes that come out of this, and how it washes out remains to be seen. I'm just looking for good value and looking to buy businesses that I think over the next 10, 15, 20 years will be more valuable than they are today, because we won't be talking about it then.
Stephen, what does this do for the budget's prized surplus?
It's shot to pieces in my view. We saw numbers from Department of Finance for the month of January on the monthly budget update. Compared with MyEFO, which was only 2 months ago, that $5 billion surplus that was projected back then is falling short by about $3.75 billion compared to the estimate back in December. And we've still got 5 months to go. And these numbers, really importantly, predate any impact on the economy, on government spending and revenue from the coronavirus. So to the extent that we've had a stalling of activity in February, and probably that's lingering into March at least, then things like GST revenue, the income tax receipts that they're going to be collecting, and of course company profits will be hit for 6 on the back of this. So I'd say the prospect of a budget surplus is almost zero, and now we're going to be looking at how big the deficit will be.
Stephen Koukoulas in Canberra and Roger Montgomery in the studio. Thank you both.
A pleasure.
Thank you.